Welcome to the Dental Team Podcast. I'm your host, Kiera Dent, and I have this crazy idea that maybe I could combine a doctor and a team member's perspective because let's face it, dentistry can be a challenging profession with those two perspectives. I've been a dental assistant, treatment coordinator, scheduler, biller, office manager, regional manager, practice owner, and I have a team of traveling consultants where we have traveled to over 165 different offices coaching teams. Yep, we don't just understand you, we are you. Our mission is to positively impact the world of dental, and I believe that this podcast is the greatest way I can help elevate teams, grow VIP experiences, reduce stress, and create A-teams. Welcome to the Dental Team Podcast. Hello, Dental Team listeners. This is Kiera, and today I'm so excited. I have a dear friend on the podcast today. We've podcasted a few times. We've gone on so many different fun conversations, and I'm excited to bring him back. We're going to talk all things taxes. Let me get this like a sexy podcast for you. But I've got Derick Van Ness with Big Life Financial. Derick, how are you today?
I'm great, Kiera. Just excited to be back and talking about a topic that I don't know if I ever thought I'd be passionate about until I realized taxes are such a big impact on people's finances that I've actually become passionate about them. I don't admit that in public that often, but yes.
I love it. Well, I don't like taxes. So someone gave me a different mindset on taxes. Amanda Francis, are you familiar with her? She's an author. She wrote Rich as F, and she's like sitting in a bathtub of money. It's like kind of a funny one. It was a really interesting book for me to read. And she talked about how like taxes are like the benefit of living in a country that allows us to have businesses and to grow businesses and to evolve. And it really changed my perspective of just like the gratitude for the country I do get to live in that allows me to have a business. But with that said, I also don't like being dumb and paying more taxes than I need to. Like I'm obviously going to pay them. I'm never going to do tax evasion because that terrifies me. Like my rules are nothing shady and nothing that's going to put me in jail. Like those are my rules. So beyond that, I'm willing to play in the gray zone. But I just think the more we can educate ourselves on taxes, the more we can play the game. And I feel like the game of taxes is like worse than the Monopoly handbook. Like there's so many rules to Monopoly. There's so many rules to like Risk and those two board games. And yet I feel like taxes are a board game that we just need to learn the rules. So the more I can learn about taxes and be grateful for the country I live in, then here we go. So let's talk about taxes, Derick. Let's like dive deep into taxes. It's end of year, and this will be released before the end of the year. So let's give some people, some listeners, what they can do for taxes, whether they do it this year or if they just prepare for next year.
Right. I mean, the first thing people can do is, of course, tax planning all year, right? Like you don't do business planning just in one quarter of the year and then the rest of the year not think about it. People forget taxes are the biggest cost in your life. Even if you have kids in college, like most of the people listening to this are dentists, right? And most of our clients are dentists, and most of them are in the top tax brackets. So if you're in those, you're somewhere between, if you have no state tax, maybe 35 to 40 cents on the dollar. And if you do have state tax, maybe 40 to 45 cents. Some even in California or whatever can push the 50% mark.
Yeah.
That's 50% of everything you make or 40% of everything you make. It's huge, right? And I think people don't think of it as part of their business. Right? But if you had something else that was sucking up 50% of your profit, you think you'd pay attention to it?
Yes.
Right.
Absolutely.
So mindset wise, right? Like I agree with you that we need taxes. We need to pay for roads and schools and all the different things that need to be done. However, I'm not a fan of people overpaying taxes due to ignorance. Right. So what we want to do is help you understand what's possible. And then you decide what's right for you, right? Work with your tax pro to figure out the things that do or don't apply for you. And like you said, we don't go into the gray area either. We really stick with black and white tax code. We read the language. And a lot of tax stuff, just so people know, it's not about like people say, oh, you have a home office, that's a red flag. Well, here's the thing. If you actually have an office at home, this is my home, and it is exclusively office space, writing that off is not a red flag if it's real. What is a red flag is if you have a laptop in your bedroom and you call it a home office. And that's not a red flag. It's just lying, right? So let's be really clear that the rules allow you to do things. You just need to document them and do them in the way that the tax code says you can. If you go to Hawaii with your family and you meet with one real estate agent to like say, what would it cost me to buy a timeshare? You can't write that off as a business trip saying, well, we were looking at a second location. Like it's just lying, right? So
Mhm.
I want to be honest about that because a lot of stuff that people say is shady is people writing off stuff they're not really doing, or saying they're doing things they're not, or exaggerating what they're doing. Just be honest about it. It's okay. As a dentist, you make enough money. If you're not doing these things, you can pay the taxes. But there are a lot of things that you're already doing that you can be writing off, and there are a lot of things that you want to do and that you can get tax breaks for. So that's where we want to focus is behavior modification a little bit. I mean, truly, I believe that that's what the government uses taxes for, is to get you to do stuff they want you to do.
Right.
You know, you get tax breaks for having kids. Well, why does the government want you to have kids? More people, more prosperity, more stability. When people are parents, they're not so wild and crazy out there doing crazy things, driving too fast, or whatever other vices people have. So let's focus on that. Buying a house, they give you a tax break for buying a house, although with the standard deduction, some of that's gone away. But because well, people who own houses have pride of ownership, and they take care of their neighborhood, and they look out for crime. Those are all good things for our country. And there's a ton of other things that they allow you to do that people just they think it's too good to be true, but they forget. You get to write off your house, you get to write off your kids, you get to write a ton of stuff off for your business. It just seems too good to be true because you didn't know about it,
Mhm.
right? So we want to be clear on those kind of things, and maybe we can dive into a couple of. There's some really easy strategies. Some of these people have definitely heard about, but they're the things that apply to almost everybody. And then there's a whole other category of stuff that's higher level. And I actually recently published a PDF that we give away on our website called "Tax Strategies Your CPA is Not Telling You About." Right?
Ooh, I want to hear it all. So let's do the easy ones, and then
Yeah,
because
yeah,
again, I don't know, Derek. I love podcasting, and I've done hundreds. Like we are almost
yeah.
pushing 800 podcasts now. And I just think about like I do this to learn selfishly for myself. Like yes, thank you listeners for
Sure.
having a place for me. But like shoot, if I can learn tax strategies, I'm going to. So let's do the basic ones, and then let's do the ones
Hmm.
that people aren't learning because I found I put it on my goal board because I got so sick. Like Derek, I got so angry at paying stupid tax bills. I was like, screw
Hmm.
that. I'm going to become a tax expert. Like, I don't care what I got to do, but I'm so done with this. And I still feel like there's like layer upon layer upon layer upon layer. I
Yes.
think I'm getting smarter and I don't have to surprise bills, but anytime I can learn. So let's talk about the basics, especially geared
Okay.
towards dentists. And then let's
Uh-huh.
dive into the ones that people aren't telling you about.
Okay. So let's start with the super basic stuff. If you've heard this before, hang with me and we'll get to the stuff you probably haven't heard of. First one is yes, you can pay your kids, right? And paying your kids allows you to pay them. The number changes every year, but right now it's pushing $13,000. But let's call it $12,000 a year. But if you're going to pay your kids, and this is where everybody, once again, are you lying or are you telling the truth? Your kids have to do something.
Right.
So if your kids are old enough, I mean, kids are great at video production. They're good at marketing. They're good at social media. They're good at all kinds of things they can do to help you in your business. They can also sweep up and file and do all kinds of things that way. And if you have young kids in the digital world today, your brand, most dentists, their brand is a family brand, right? So use your kids in YouTube videos, use your kids in on your website, use their likeness and pay them just like you would pay any other spokesmodel or actor, actress, but you have to use them, right? One picture on your website probably doesn't justify that. Make them an active part of what you're doing. Let people know who you are because listen, like what I do, dentistry is a high trust industry. People need to trust you. It's very intimate to have somebody poking around in your mouth that you don't know or trust, right?
Right.
Just like people poking around in your finances, they want to know that we're like trustworthy.
Mm-hmm.
So same kind of thing there. Use your family that way and allow them to be involved in the business anyway. And then as they grow and their skill set changes, you can pay them for different things. But let that money, it needs to go into an account with their name on it. It needs to be their money. Your name, of course, can be on it, but they can pay for their own schooling. They can pay for their own dance or football or whatever they're doing or with money, but allows you, instead of paying 40% in taxes and then you paying for the stuff, they can pay for some of their own stuff, right?
Mm-hmm.
Or put it toward a college fund or other kinds of things that they have control of. So it's really their money, but you're just helping them just like you would as a parent to be a good steward of that money, right? So that's an easy
Okay.
one.
Well,
Yeah,
and I like that you also brought up the ideas about kids are really good with social media. They're good with video editing. And I hadn't thought about that for kids. Like I mean, I've heard about people like having them shred the papers at the job. I've heard them, like mow the lawn at the office. But I mean, that's a great idea because they are good with social media. They're good with bringing people in. That's a
yeah,
skill set that I think the younger generation is really, really, really talented at. And
yeah,
they could definitely help out with that. I think that's a brilliant idea that I hadn't thought of, especially for those like middle school, teenage years,
for
kiddos that
sure.
really could actually benefit your practice for you.
Yeah, yeah, they can help you do a lot of things that you know you're practicing dentistry, right? You're not practicing social media. Kids spend so much time doing this stuff that they figure it out, most of them, right?
Yeah,
So definitely play to those skill sets or those interests.
smart.
Um,
Okay, next thing, pay our
se-
kids, give them
yep,
a real job.
yeah. Second one is something called the Augusta rule. It's a
I
home
love
rental
this
rule,
one.
right? What's
Yes.
that?
I said I
Yeah.
love this one.
Yeah, especially for like what you do, Kiera, dealing with teams, right? So you do retreats, you do planning sessions, you do meetings with your top leaders in your office, and all of those things. Usually, if you want to do that off-site, you've got to rent a hotel room or like a conference room or an event center or a place in the back of a restaurant. Instead of paying those places, you can use your home for it, and your business can pay you for the rental of your home. And the first 14 days a year that you rent out your home, you can take income tax free. Okay. So it's a way to get money out of the business into your home. These are things you're doing anyway, at least most offices, right? Team meetings, retreats, team building, all kinds of stuff, holiday parties. We're at that time of year, um, beginning of year planning, quarterly planning, all that stuff. Anything you would normally go and rent another facility, you can do it. And you want to have a real lease between your business and you personally, just like you would with a hotel or anything else. And if you want to really be airtight, take pictures of what you're doing and go in and like let's say you're using 400 square feet in your home. Go and find what would it cost me to get a 400 square foot conference room for the day, right? At a local hotel that is as nice as your home is, because most dentists have pretty nice homes,
Hmm.
right? What's that going to cost you? $1,000, $1,500, $2,000 a day? I don't know. It's different if you're in New York City than if you're in a small town somewhere. But figure it out and print out a copy or two of comparable rental spaces, right? Now you know you're charging market rent, but the money's coming out of the business into your home personally. Once again, that's something you can do up to 14 days a year, and you're getting money out of the business into your personal life without having to pay taxes on it, right? So 40 cents on every dollar that you pay there.
Hmm.
It's not going to change your life, but it's probably for a lot of people worth $3,000 to $10,000 a year,
Hmm.
right? For
It's tax
stuff
free
you're already
money.
going to do. Yeah.
Like, why not? Something I did, Derek, because I get scared about this. And so every year in January, I have a reminder task in it is I go and I do Airbnbs in my area. I take
Mm-hmm.
screenshots of them. I keep them in a
Mm-hmm.
folder. I make
Yep.
invoices every single time. I send them to my CPA when I complete my like meeting at my house.
Yeah.
Because I feel, and then I also have it in my calendar because I feel like if the IRS were to ever audit me on it, I want to have multiple places. I love the idea of taking pictures because we could definitely start snagging those in there, but just having
Yeah.
it to where like I think if you just cover your bases, it's very easy to do, and why not? And to me, that takes literally, I kid you not, it's about 5 minutes every single month when I make the invoice. It's me taking about 30 minutes at the beginning of every year to go look at comparable properties to my own and
Mm-hmm.
then utilizing it that way. So, very, very simple ways to do it that you
Yep.
can then make sure you're covered on. It's
Yeah. And
awesome.
the reality here is, are you doing it right? If you're really doing it and you just document it, it's a no brainer.
And I think for
So
some offices, like I felt weird about like, well, I don't have my whole team here, but you can have like leadership meetings at your house. You can
for
have different
sure.
things. You could do breakfast. So it doesn't have to be a big, like extravagant party that you would do. It can even just be your leadership team meeting at your house every single month. You have it offsite, which I would actually recommend for leadership teams. Get them
Yep.
offsite.
100%.
You'll probably get more talked about in confidential spaces than you would in the office anyway.
Well, there's a lot of value in just changing the environment,
Mhm.
right? When people are in an environment, they're thinking a certain way, acting a certain way. When you can get people off site, it changes the vibe, it changes the energy, it changes the way that they react. So, yeah, I think the psychology behind it's really important. Whether you decide to use a hotel or you use your home, offsite meetings are really, really valuable. So,
Mhm.
I agree with that 100%.
And I did
Okay.
feel weird. I'll just put it out there. Like, I did feel weird having my team come to my house for a while, which is
Hmm.
why I think also you can have it smaller so it's not your whole team. Because it was weird for me when I had teammates working in my house, like, because it is still my personal living space. And then my husband lives
Sure.
here, and we have, some of you have kids. So I also think some of those more intimate, like leadership teams, doesn't feel as daunting to have a whole team over if that feels weird to you. So just there are ways to get around it if that feels maybe a little scary to you, because I know for me, especially as a female, it felt weird to have team members come over. So I just kept it very small to my leadership team, and that feels much more doable to me. Just as my 2 cents on that.
Yeah, and like I said, I'm not a CPA giving tax advice. That's, not what I do. But what we're doing here is saying, hey, this is a possibility. Think about what's right for you. Think about how you want to use your home. Think about tax wise what works for you. Work with your tax pro to determine, how to document that. But, at the end of the day, these are things you can be doing that you're already doing anyway. So if you make a small tweak, now all of a sudden you get tax breaks for those.
Brill. I
Third
love
one
it.
here that is pretty important and a little less known is cost segregation. So if you own the building that your practice is in, or if you own any commercial real estate, there's a way to accelerate the depreciation on that building through cost segregation. So this is really well known, but cost segregation is basically the idea of you have the building and then you have all the stuff inside the building. The build out, the electrical, the AC units, the plumbing, all of that stuff. And you can actually separate the two of those. Normally, commercial real estate is depreciated over 39 and a half years. So it's a long time, right? You don't get a lot of write-offs. Over
Hmm.
time you do, but not each year. If you take and do a cost segregation study, an engineer comes in and they come in and they separate what's the physical building and what could be classified as equipment, all that build out stuff we talked about. And equipment can be depreciated much more rapidly, 5, 7, 10, 15 years. So you're getting double, triple type of depreciation. Or if you do new build outs, you can do that as well. Like if you remodel the whole thing and strip a building down, all of that. And the first year that you do depreciation on new build out stuff, you can also get bonus depreciation, which is 80% in the first year right now. It was 100% for a couple of years. Now it's phasing out. It's 80% this year. 24 will be 60, 40, 20, and then it'll be gone. So you can take advantage of that as well. But if you own commercial real estate, this is a really nice opportunity if you have passive income. The big thing about real estate is that it gives you passive losses, and passive losses can only offset passive income. Now, there is a way, if you're building a new building, and this is something you'll want to talk to your tax pro, there is a way because for an owner occupied building where you have your practice inside your building and you own it, there is a way to be able to do that so that it can offset active income because it's part of the same business. It needs to be done right away, and there's some nuance to it. So make sure you talk to your tax pro about how to do that and if it applies to you. But if you're doing a new building or a new build out, that's a possibility. If you've had a building for 5 years, it's probably not going to work. You could still get the advantage of cost segregation. But for you as a dentist, if you can get massive depreciation to offset your active income, that's like the holy grail.
Yeah.
So definitely something to look into. There are companies that do cost segregation. We can make recommendations, or maybe Kiera can. It looks like you're nodding your head, so maybe you're very familiar with this. But
I'm just familiar with like real estate. I didn't realize you could do it with dental practices. Like that's so clever, and I had not thought about it in that realm. And there are people who know when you're doing a cost seg what you're trying to do it for, and
mhm,
so like getting good recommendations. Derek, you're going to know way better than I will. So I would say if you're
yeah,
interested in that, definitely chat with Derek on that. But yeah, the cost seg is done in real estate gurus across the nation, and the bonus
yeah,
depreciation. If you can take advantage of that now, because it is going away, and that's something where it's like that is a huge benefit to get the bonus depreciation if you can. So even if you're thinking like, hey, I might build a new building next year, or we might do something next year, and it doesn't have to correct me if I'm wrong, Derek, but it doesn't have to be a new building, right? Like I could just buy
no,
another building because it
yep.
could be a new, or I think you'd actually do better if it was a purchased building than a brand new one because you probably would get more depreciation off of it. But I'm guessing for both you can get it. Is that correct?
Well, they take the value of the building when you buy it. So when you're a new owner, you start over with the value of the
Mm-hmm.
building,
Right.
right? And so then you get to depreciate that. But you can go in. I mean, if the last guy did cost segregation and then he sells it to you, that does not impact you. A new building, obviously the value is going to be higher, and the big thing
Right.
with a new building is you can show that that's part of your existing business, like it's an integral part. They do the same thing, and so you can get that active income offset. I'm going to
Nice.
be honest with you. I understand that it can be done, but I don't do the nuance of that. I have my tax guy do it. So
Yeah. You and me
definitely, I
both.
don't want to give too much detail on that, other than if you own a commercial building and you've had it less than 10 years and it's worth over $250,000, I think it's worth looking into. If your building is, is really small and not worth very much, or you've had it for a really long time, so most of your depreciation's gone, it may not be the strategy for you. But for most of my dental clients, like their buildings are worth a pretty penny and they're relatively new. So
Hmm.
definitely worth checking out.
Brilliant.
Um, yeah, so if that one applies, it's a big deal. And then the last one that's really obvious is balancing your what you take as your W two with what you take as your dividends, or your I call it owner's income versus
Hmm.
W two income, right? Employee income. And so how you want to balance that is your W two should be consistent with what would you pay another employee to do your job. Like if you had to hire someone to do your job, a lot of associates make, let's say, $150,000 a year, right? You as a dentist, let's say you make 500, then you can take the other 350 as owner's equity or dividends, right? And it's taxed differently than the W-2 is. The
Hmm.
big difference is when you're taking the money as dividends, you are not paying the 7.5 self-employment tax, 7.5% self-employment tax. And there is a point where that 7.5% deduction like goes away, but you can take a really nice chunk, 6 figures plus that way, and it'll save you 7.5% on each of those dollars. So it's a more efficient way to pay yourself.
Hmm.
You can talk to your CPA or your tax pro about how to set that up. But basically, if you're paying yourself all W two, like a lot, I see this a lot with newer dentists who have maybe don't have an S corporation or anything yet. They're paying themselves as a sole proprietor, and so everything is taxed as ordinary income. I would say as soon as you get to the point where you're making, and most dentists clips this very quickly, 75 to $100,000, you really need to be looking at this, because you're going to be getting to the point where you can start taking some of that, the money that's made from hygiene, the money that's made from things that
Hmm.
you're not doing, you can take that as dividends.
Smart.
So yeah, so once again, just a way to be more efficient. And we found that if people just do, if they have a couple of kids and pay their kids, if they do the Augusta rule at a reasonable rate, and they not even counting cost segregation, but if they just do this owner's draw versus W two balancing. Another rule that a CPA gave me, if you're looking for a general idea, is about a third of your overall income you should probably pay yourself as a W two, at least that much.
Smart.
Once again, talk to your tax pro about that. But between those three things, we find that for most people, it's worth $20,000 to $30,000 a year in tax
Hmm.
savings. So, and that's the stuff. Honestly, a lot of people talk about. Right?
Yeah.
It's pretty common. It's out there. So we're not like changing the world here. But if you don't know about these things, then they're things you want to probably explore. Uh,
I think it's brilliant, Derek. And I'm just going to chime in on that. Like, I don't know. I feel like as business owners, there are opportunities that we have, and I love to get a good ROI for my time. These things are so simple.
mhm.
It's a very simple conversation with your CPA, and if it can save you 20 to 30,000, I feel like I'm on like a Geico commercial. Like 1 hour with your CPA can save you 30,000. I think I don't know many dentists that produce 30,000 an hour. So just looking at that cost to benefit ratio, I think it'd definitely be a smart idea. So I'm dying to
Agreed.
know, Derek. Tell me all the non things.
Okay, so we're going to get a little bit more general here, because a lot of the tax codes that are out there, once again, the government is incentivizing you to do certain things, right? They want you to put your money certain places or spend it certain places or do different types of things. So they encourage that. So there's a category of things out there that we call tax smart investments. So these are investments that when you put money into them, you get big tax breaks. An example would be opportunity zones, right? That's something that came about after the 2017 tax rewrite. The government wants to redevelop areas of the country that aren't um, that aren't doing so well. Inner cities, rundown areas. They want to inject new money. They want investors to come in. You can use dividend income, income that you get as passive income, to invest in those things, and you can you can do that tax free. Like you don't pay taxes on the money that came out of the K1s. So if you have that type of income, that's an example of the government incentivizing you. Just so you know, opportunity zones, they're pretty nuanced. You need a good team. This isn't something to just try and do on your own. You need to
Agreed.
talk to people who do that kind of thing. But that's an example. Another example is we're in an energy crisis in the world, right? Especially with the whole Russia Ukraine thing, kind of exacerbated that. But oil and gas, a lot of oil and gas types investments offer really good tax breaks. Some of them as much as 90% or more you get to write off as a tax break, which is pretty cool,
Mm-hmm.
and can save you considerable amount of money. So if you're looking to invest in a different asset class outside of the stock market or something, that might be something worth considering as an investment that also has tax advantages. And there's lots of different things out there, but energy is like a real hotbed for that kind of stuff right now. We've seen other types of investments out there that do that. So just know, without me getting into specifics or being giving tax or investment advice, that there are tax advantage investments. So you could talk to your investment advisor. You could talk to your CPA or tax pro about that, and they could probably point you in a direction of things that they think are worth considering. Right.
Mm-hmm. Mm-hmm.
So that's another group of things that people don't even realize are out there. Um, there's a whole group of things we call leveraged donations, and these are a little tricky to find sometimes. Once again, investment advisory groups and other kinds of tax groups might know about them, but they're essentially things where you are able to buy something at wholesale and then donate it at retail, right? So we worked with groups that have done this with medical supplies, where they buy all the different components at wholesale. They get assembled and put together and then donated at retail. Some of these ended up in Ukraine and other war-torn areas last year, where you can, for every dollar you put into it, you might get a $5 write-off, right? Could be four, could be five, could be six, just depending. We've seen ways to do this with other types of things: art, real estate, land, other kinds of things. So what these allow you to do is make donations and do good in the world, or a lot of them are investment opportunities, and you could buy them wholesale and turn around and you could make money on it as an investment, or you can decide to donate it, right? So there's opportunities there where you're getting a really good deal on something, and that's the trick, right? Where do you buy something that you can buy it at 20 cents on the dollar or get access
Mm-hmm.
to it at 20 cents on the dollar? But these are things, and there are groups out there that find and put together these types of things, either as investments or potentially as donations. So they
Mm-hmm.
can be really powerful, either to grow wealth or to get a nice tax break, depending on what your focus is and the group you're working with. So I think that's something a lot of people don't know and understand. And I don't get into the specifics because honestly, what is out there and available from different groups changes from year to year, right?
Mm-hmm.
It depends on what are they getting access to and what are they able to make the numbers work for the investor, for you as the investor. But these can be pretty significant when you get on the donation side. If that's the direction it ends up going, you can offset between 30 and 50% of your adjusted gross income, which is a lot of money. And we have some clients looking at these types of things with their tax pros to see if they're appropriate, but it could be hundreds of thousands of dollars of savings for some of these guys with really big practices.
Mm-hmm.
So it's pretty significant stuff.
Well, and I like that because it doesn't hurt your cash flow per se. Like you're spending a dollar and saving $5. Because a lot of times, like with these deductions and the different things we have to put into play, it does require the cash. So yes, it does
Mm-hmm.
save you, but to have it like completely written off or to, I mean, 1 to 5, I was like, sweet, I'm gonna definitely wrote it down there, Derek. Gonna ask about that. That's a great idea.
Well, on the 1 to 5, how it works is this: $1 donated is like $5 write off. If you're in a
Correct.
40% tax break or 40% tax bracket, a dollar to offset $5 of income is like 20%. Does that make
Mm-hmm.
sense? So it's
Mm-hmm.
sort of works out to almost be double your money as far as how much you save in tax versus how much you donate.
Totally.
So it's not a 5 to 1 that way, but close to a 2 to 1 depending on your tax bracket and the situation.
But the fact that it's not a 1 to 1, like $1 gives me $1 here, which is 40% or whatever your tax
Yeah, yeah,
bracket
yeah.
is. The fact that I get to leverage that money with less cash, I think is the clever thing on that one.
For sure. Yeah. Well, the first time I saw that, I was like, this sounds too good to be true.
Right.
Uh, yeah, yeah. And, there are things out there that had gone under scrutiny, but most of these are pretty well known now, like by the IRS, and have been figured out. They've restructured, like people were familiar in the past with conservation easements. Those have been restructured. The government has said, well, here's the way we can do it that everybody agrees on. They're not red flags anymore as long as they're done right. But you can't offset 50% of your adjusted gross income. They're going to do it through a different tax code as a fee simple land donation, and it's more like 30% of your adjusted gross
Interesting.
income. So there's some limitations that have happened there where it was a compromise, right,
Mm-hmm,
between
mm-hmm.
what the freewheeling entrepreneurs are out there putting together versus what the government really wants to see happen. So there's some middle ground that's happening there.
Very cool.
Another one, and I know you and I have talked about this a lot, Kiera, is research and development credits.
Mm-hmm.
We work with so many dentists, and dentistry is changing so fast with technology and new equipment and new diagnostics and new materials and all the different things that if you're not taking advantage of research and development credits and you're bringing new stuff into your practice, you're leaving dollars on the table, right?
Right.
So I won't go too deep into that one, other than to say if you're doing new stuff in your practice, bringing in new technology or equipment, it's definitely worth the conversation. For a lot of our dentists, this is super, super broad strokes, but they're seeing maybe a 1% credit, right? So if you have $1 million going through the practice, it's probably $10,000 to $15,000 a year. If you've got a bigger practice, 2 or 3 million, it's probably pushing double that.
Mm-hmm.
It can be a significant chunk of money. It's in and of itself not a total game changer, but an extra 10 to 20 grand a year goes a long ways for paying towards college for your kids, right? Or
Totally.
whatever you're saving for.
Right.
So you can see as you start to stack all of these, and not everything's for everybody, it gets really powerful. And where this stuff really gets good, Kira, and this is something I think most people don't think about, is you want to start thinking about taxes, A, as part of your business, but B, multi year. Most people, and I joke about this, there's something in the turkey that at Thanksgiving, everybody eats their turkey sandwich or their turkey for dinner, and then they call me the next day and they're like, I got to think about taxes. And it's like it's almost too late, right? A lot
Mm-hmm.
of the big things you can do to take a little education, you got to move some money around, or you got to do some things, or things like the Augusta rule, paying your kids, whatever. You want to do that throughout the year. If you're writing
Right.
a check for this stuff on December 31st, it doesn't smell quite right,
Mm-hmm.
right? So these are things where you start with the plan in the beginning of the year, and we're a big believer in like calendar based planning. Beginning of the year, setting some targets and objectives, putting an action plan in place, saving the money, putting it aside, knowing that I'm going to need money for taxes, I'm going to need money for investments, I'm going to want to do different things throughout the year, and having that stuff systematized and automated as much as you can.
Right.
Then, when you start doing tax planning, and we think you should start in August or September,
Agreed.
you've got, you're like 8 or 9 months through the year. We kind of know how's the year shaping up. Where do we think we're going to end up income wise? What types of strategies are appropriate? And starting to put those things into play, but you've saved the money all year. Now you've got a chunk of money. You're not saying, well, God, I just wrote last year's tax check on October 15th. Now I'm broke and I don't know what to do this year. You've been putting money aside. You've been, planning throughout the year so that you're prepared. And
Mm-hmm.
that's what you would do with your business, right? You look at your cash flow, you look at your projections, you save up for things that you want to buy. It's the same thing. It's just for some reason people don't do it with their finances personally, or tax or financial planning stuff. It's
Mm-hmm.
crazy to me. So that's
Yeah.
the idea.
I love it. Because I think that when I used to feel like it was like some mystery on taxes. Like, okay, I just wait and you guys tell me how much I owe. And when I realized, like, no, Kira, it's going to be like 35. I go 40. I'm always a more saver than not
Yep. Yep.
of my profit every single month. And what I love, I don't know, Derek, I love a good deal. And so I love to throw it over in a high yield savings account. And so that money is making me money throughout the year
Yep.
and I'm
Yep.
saving it. And then I don't have to be scared at the end of the year for that tax conversation. So I agree. I meet with my CPA in July and then we have another conversation in October, but I'm saving January, February, March, April, May, June,
Yeah.
July, and I feel like less crying, more smiling, and it's just simple. Like But that I agree. It's we think that we have all this money, but when I realize like, no, I actually don't have all this money. And if I put it
Yep.
away, then I can make smarter decisions with the money I actually can spend. And then when I look at my tax bill, I have the money. So like what was really cool this year was I wanted to make a pretty big investment. And because I had already saved the money for taxes, we knew how much that investment would reduce my tax bill. So I didn't have to go
Hmm.
find that money. I was able to use that money from money I've already saved. And I only had to put forth the additional like 60%, technically 65%, because I was
Hmm.
able to reduce my tax bill that much. So I don't know, Derick. I'm with you. Get organized, start saving, save every single month. You know it's going to come,
Right.
you know it's going to come. So you might as well put that money there and make money off of it while it's sitting over in a bank account. And then for me, I put it in a third party account just so I don't see it all the time. So that way it
Right.
accrues. I can check in on it. Then when I have my meeting, I can see did I save enough for it. But that's how I stopped crying in December because I used to like alligator tears cry when my CPA would call me. And I'm like, this has got to stop. I hate the call. I don't like having Thanksgiving be ruined and then Christmas is ruined and then New Year's is ruined and I'm ticked off until April and I don't want to write this dang check.
Yep.
Just have it prepared. More smiling, less crying.
Yeah, yeah, and that's it. I think of it as dealing in reality.
Mhm.
You're gonna have to pay them, so save for them, and then when you have to write the check, you just write the check, right? Like you
Right.
said. And obviously, there's a ton of things you can do strategically along the way to minimize that check. But you want to be writing checks. It means you're making money, right?
Yep.
So, yeah, I agree with you 100%. And we're really pushing for two things. One, for people to proactively plan for taxes and for their financial well-being. And we think, and this is just my own personal belief, take the money you saved in taxes this year and put that toward building wealth next year. Instead of buying a pool or a fancier car or whatever, take that money, put it to work where it's going to build more money for you next year and then save all year, of course, doing your normal thing. But if you can take 10% off your tax bill, right? Go from 40% to 30%. Take that extra 10% on top of what you'd normally save and start putting it to work. The difference in how quickly you build wealth outside your practice is going to be massive. Like the
Mhm.
shift is pretty remarkable. Um, and so I think that's a big thing is when you save the money, not just spending it, but really putting it to work effectively. And that could be reinvesting in your business and equipment or other things. But if you've got that part squared away, putting it to work elsewhere, make those dollars productive instead of consumptive. I'm not saying to not like live a better life, but I am saying that you know if you were planning to give it to the government anyway, you may as well give it to yourself. I jokingly call it a government sponsored retirement plan, right? Just being good at taxes, and it makes such a difference. It cuts that down. Helps a lot of dentists when you get a little bit older and you don't want to have your foot on the gas so hard. You can step back a little bit. You don't have to be like crushing those numbers every single month. You can enjoy your work. You can spend more time with your team and your patients. Um, and you're not so worried about it because you've done the other things all along the way that make a difference, right? It's the
Mhm.
whole by an inch it's a cinch, by the yard it's hard.
Mm.
So
I like that, Derek. I'm going to use that one. By the inch, it's a cinch. By the yard, it's hard. That's clever.
yeah,
I've never heard
I
that one.
I didn't make it up. My dad used to say it to me because he's like,
Really?
by the inch it's a cinch, by the yard it's hard, but Derek likes to do things by the mile.
I love it.
So
I love it.
yeah.
Well, Derek, these were so helpful. And I love that you talked about the simple ones and then the not so noticed ones. If people are interested, you guys, Derek does a ton of things. He does the ERC, they do R&D credits. We've had several clients work with you guys. You guys have tax
Hmm.
strategy. I love
Hmm.
that you're a tax and wealth strategy. So, Derek, if people are interested, they want to just contact you. I've chatted with your team. You and I have had many conversations about this. I think you're very, I love that you educate as opposed to push. And like, if it's right, it's right. And if it's not, it's not. But if
Yep.
people are interested and want to connect with you, how can they get connected with you?
The easiest thing is just go to biglifefinancial.com. There's a link up in the corner that says work with us that you can click. We are also giving away the book. At least right now, it's free for the tax strategies your CPA is not telling you about. There's a bunch more things listed in there that we didn't cover today. I just kind of hit some of the highlights, but you can always download that and check it out. But yeah, that's a great way to get started. And then from there, you can look around or whatever makes sense, but the website's the best way.
Cool. So biglifefinancial.com. I would go snag that resource. I'm definitely going to. So, Derick, I appreciate you today. I appreciate you always. You have taught me so many things about emotional ROI and about R&D, ERC, about building wealth, about how to look at my dollars differently. I think you've taught me a lot of mindset shifts. And so I
Good.
just appreciate you in my life and for a lot of our clients' lives. So thanks for being on the podcast today. I super appreciate it.
Loved it, Kiera. Thanks for having me.
Of course. And for all of you listening, stop crying, do more smiling. Let's commit to like paying less taxes and being less stressed in a legal, ethical way. But for all of you, truly, it's a great way for you to invest in your future self and to make life easier, more smiles, less crying. And as always, thanks for listening. I'll catch you next time on the Dental Team Podcast.
And that wraps it up for another episode of the Dental Team Podcast. Thank you so much for listening, and we'll talk to you next time.